This is all normal. This is how equity markets work. Days like today are actually the healthiest days for equity markets in the long term because they clear out the froth and they make room for investors to say, yeah, we can get past our fear and then see things grow from there. There certainly are, some things that you have to watch for economically over the next couple quarters. There's no doubt about that. But whenever we discuss the long-term returns for the S&P 500, they're inclusive of recessions. It's not like when people look at the long-term returns in the market, they're like, well, you just had to stay out. No, the S&P 500 has done what it's done historically. Should I give the speech, Mike?
You can, but I guess
I'm going to give the speech. I'm going to give the speech.
It would be far more concerning today if we got this jobs report and the stock market was flat or up. Like, this is normal. This is to be anticipated. And I don't know what's going to come next, but it would be far more concerning to me if we saw this lousy job report and investors just shrugged it off.
I'm going to give the speech, though, just because we got a new affiliate out in Portland, Oregon this week, and they've never heard it before. So I'm going to give the speech. The S&P 500 in one form or another has existed almost 100 years. In its current form, the S&P 500 has been around for about 75 years. And if you look at the data that we have, that again suggests that the long-term median returns for the S&P 500, depending on the time frame that you look at, are generally anywhere between about 8 and 10% a year. Well, this is during a period in which a lot of bad stuff has happened over the last 100 years. World War I was before that, but you had the Great Depression. You had World War II. You had the, return of all of the veterans from World War II and the subsequent recession that happened then. You have the Korean War. You've got JFK being assassinated. You've got the Vietnam War. You've got the inflation and the oil shocks of the 1970s. You've got, the 1980s with, a big recession when Paul Volcker threw the economy into a recession in order to save the dollar and reduce inflation. You've got, Black Monday in 1987. You've got Desert Storm in 1990 and 91. You got the early 90s recession. You got the tech bubble bursting in 9/11. You got, one president being impeached, you got multiple presidents being impeached. You got a couple more assassination attempts that you've had on presidents. You got, the invasion of Afghanistan. You've got the housing bubble and the greatest, financial crisis that the world had seen since the Great Depression. You got, the COVID pandemic a few years ago. You got all this stuff. And by the way, I just, this was a minute. I missed a lot because a lot of bad stuff has happened over the last 100 years. And the point that I make is not that markets shouldn't move on this, because they always do. They always get scared of stuff that happens in the world, because that's the role of markets, is to try to price that risk based on what's going on. But my point is, yet all that stuff happened, and probably a whole bunch more that you remember, and you're like, Chuck, why didn't you say X, Y, or Z? The answer is because we have a limited amount of time, and I can't recap 100
and
years.
Just listen to We Didn't Start the Fire. That'll fill in the blanks.
Yes.
Right.
I really don't want to listen to Billy Joel today. Really don't. Kind of an overrated song also. Kind of an overrated artist, but we won't get into that discussion. The point I am trying to make is that ultimately all this bad stuff can still happen, and what really matters is that companies figure out ways to sell more stuff to more people in the long run. That's what drives equity markets, actually. The volatility that you see is a feature, not a bug. And just because there's volatility in markets today doesn't mean that things are going to be good or bad over the next 10, 15, or 20 years in them. We've seen all kinds of potential outcomes over that time period, but the long-term trend, the real one that matters, the 30, 40, 50-year ones, the S&P 500 has not lost money over those extended periods of time ever. Yeah, on a daily basis or a yearly basis, you can do all kinds of things. Daily, it's a coin flip. Yearly, 30% of the time in a one-year period, you're going to lose money at the S&P 500. That is how markets work, and that's how you know that they're working. That's how you know that you don't live in North Korea, where someone just sets the price of the security, and that's what it is.
Everything is good today. Don't worry.
Right, like if you have Who was the guy who was in Saddam Hussein's regime who was like, no one's invading as tanks are behind him?
I don't know.
I forget it was like the press secretary for the Iraqi regime then. He was saying, no one's invading here, and you literally see American tanks in the background. That's when you actually need to worry. Today, you've got stocks down. They're doing their job. They are reacting to what is going on. Let the market do its work, and you do yours.